So you probably think you know the Bitcoin story, right? It's digital gold, it's a safe haven meant to shield you from all the chaos in the traditional financial world. But what if the actual data from the last few years tells a completely different and, frankly, a much more interesting story? What if Bitcoin isn't the lifeboat you think it is, but actually something else entirely?
Let's just start with a number that really sets the stage. -84%. That was the brutal peak-to-trough drop for Bitcoin back in the 2018 bear market. And look, that's not some random outlier. We've seen these massive corrections happen again and again. This is just not the behavior of a stable, safe asset. This is the classic signature of extreme volatility.
All right, so here's our game plan for today. We're going to start with the huge force that really drives modern markets. That's global liquidity. Then we'll put that whole safe haven idea to the test. We'll dig into two recent economic shocks to build a totally new way of thinking about Bitcoin. And finally, we'll turn all this theory into a practical playbook for you.
Before we can even really talk about Bitcoin, we have to talk about the ocean it swims in. And right now, in today's economy, that ocean is global liquidity. It's the tide that literally lifts all boats, or, sinks them.
The sheer scale we're talking about here is it's hard to wrap your head around. At its peak back in early 2022, the US M2 money supply hit $22.4 trillion. That is a staggering amount of money. And the way it ebbs and flows has a massive impact on pretty much every asset on the planet.
So, when we talk about that huge number, what are we really talking about? Well, M2 is basically our best guess for the total amount of money just sloshing around the financial system. When M2 is growing, there's more cash looking for a home, and that tends to push asset prices up. And when it's shrinking, well, you can guess what happens then.
And who's in the driver's seat here? The central banks, of course. They're the ones controlling the taps. You can think of quantitative easing, or QE, as them slamming on the gas pedal. They're pumping money in, telling everyone to go take some risks. And quantitative tightening, QT, well, that's the brake. They're pulling money out, and that makes everyone a lot more cautious. This cycle between easy and tight money is the fundamental rhythm of modern markets.
Okay, so with that whole macro stage set, let's bring Bitcoin back into the picture and really stress test its most popular story, this idea that it's a safe haven, that it's totally separate from this system. You know, Bitcoin's whole origin story is rooted in the 2008 financial crisis. The pitch was that it was an escape pod, a way to get your money out of a system that's controlled by a handful of central bankers and politicians. And you got to admit, it's a powerful narrative.
But here's the billion-dollar question, isn't it? Does the hard data actually support this narrative? When the system is truly under stress, when there's a real crisis unfolding, does Bitcoin really act like that escape pod? Or does it do something else entirely?
Well, the great thing is we don't have to guess. We have some incredibly clear evidence from the real-world experiment that ran between 2020 and 2022, which was just a period of extreme back-to-back macroeconomic shocks.
I mean, just look at this timeline. It was a wild ride. First, in March 2020, the COVID shock hits and causes this massive liquidity squeeze. Then came the flood. Central banks turned on the money printers like we have never seen before. But by late 2021, staring down high inflation, the Fed basically announced the party was over. And 2022 brought the sequel, Squeeze 2.0, with aggressive rate hikes.
And right here, this is the smoking gun. During the liquidity shocks, those moments of pure crisis and panic, Bitcoin didn't act like a safe haven at all. Not even close. It plummeted right alongside everything else. In March 2020, it dropped nearly 40% in a single day. In 2022, it got crushed, falling 77% from its highs. But now look at the right column. When the liquidity was flowing, it was explosive. It rallied from under $5,000 to over $60,000. This is not the behavior of digital gold. It's the behavior of a risk asset on steroids.
So the evidence really forces our hand here. We need a new framework. That digital gold story, it just doesn't fit the facts. We need a better model to understand how Bitcoin actually behaves in the wild.
And the key insight is this. Bitcoin is best understood as a high beta liquidity asset. I know, that sounds a little jargony, but stick with me, it's pretty simple. High beta just means it amplifies the market's moves, both up and down. Liquidity asset means its price is incredibly sensitive to that ocean of money we talked about. So, to put it simply, Bitcoin isn't a hedge during a crisis. It's a high-powered bet on the policy response to that crisis.
So, what does this new framework look like in practice? Well, it sells off hard with stocks when panic hits. Its price is pretty closely tied to M2 growth. And here's the crucial part. It offers this massive, disproportionate upside. Investors call it high convexity, when the central banks inevitably step back in and turn the money taps back on. At the end of the day, in a crisis, it acts a lot more like a speculative tech stock than a bar of gold.
Okay, so this is all fascinating theory, but how do we actually make it actionable? That brings us to our macro investor playbook, how we turn this new framework into a real-world strategy.
So instead of just blindly dollar cost averaging every week no matter what, you can be smarter. Step 1 is to start monitoring the macro signals we've been talking about. Step 2 is to build up a war chest of cash or stablecoins. And why would you do that? Well, for step 3, to deploy that capital during the exact periods of macro fear and forced selling when Bitcoin is on sale. You're basically buying the panic, knowing that a policy response is likely coming.
And here's a little practical toolkit for you. You really don't need a PhD in economics to watch a few key signals. Is the yield curve inverted? That's a classic recession warning. Is the M2 money supply starting to grow again? That's the fuel for the next big rally. Are credit spreads blowing out? That signals financial stress, and it could mean a huge buying opportunity is just around the corner.
You know, this quote just perfectly captures the mindset you need to have. The asset itself has proven to be incredibly resilient. It survives every storm. But surviving its insane volatility requires a plan. Understanding its true nature as this high beta liquidity asset is the key to going from being a forced seller in a panic to being a long-term survivor.
So let's end with this one big thought. We've seen central banks step in to manage every single crisis for decades now. If that cycle of boom, bust, and then bailout is now just a permanent feature of our economy, what does that really mean for an asset that seems custom-built to ride those exact waves of liquidity? That right there is the real question to ponder.